Thanks again, Andrea, for joining us virtually, but for being here with us. The floor is all yours. Thank you.
Okay, thank you very much, Manuel, for the very nice invitation. Hopefully there will be like an opportunity to come in person. I guess everybody is telling you that, but you know, it would be great to come to South Africa. So this is a joint work with several co-authors. You can see here, Sumit Agarwal from NUS, Thomas Kigabo from National Bank of Rwanda, Camelia Minoyo and Andre Silva from the Federal Reserve Board. I am from the IMF. So the usual disclaimers apply for all the institutions that are involved. As Manuel said, if you want to jump in and make questions, please go ahead. Otherwise, I will try to present the paper quickly so that you can have a discussion after the talk. So this is a paper on access to finance, and it's a paper on Rwanda, as you can see from the affiliation of one of the authors. So let me jump to the next slide. So the motivation is relatively straightforward. There is especially in economic development, there is a very large literature that tells us that financial inclusion is a very important driver of household welfare and economic development and economic growth. There are many papers making a number of points, a number of channels through which financial inclusion can matter for development. That said, aggregate statistics shows that about 1/3 of world population is unbanked. And this is not only a problem or not only a characteristic of developing countries. So generally, these numbers are quoted from the World Bank number from Findex. But even if you look in advanced economies, like if you take the US, for instance, 7% of households do not have a bank account and 20% of households do not have access to bank credit. I'm from Italy, and similar numbers, if not higher, are abided in Italy and in European countries. So even though financial inclusion is extremely important, there are a significant large share of population, especially along some demographic, which is not included. The slides move very slow. Then there is also a very vast literature on microfinance, especially the first wave of studies on microfinance were showing sort of very positive effect of microfinance for household welfare and economic growth. But and clearly we're showing that microfinance institutions were very important to boost financial inclusion. That said, the evidence on the effectiveness of microfinance is somewhat mixed. In the paper, we try to sort out this literature along two strands. There's one part of the literature which is mostly based on randomized controlled trials, and the RCT literature show what, in the words on Banerjee and co-author, is a consistent pattern of modestly positive but not transformative effects of microcredit. And there are other papers, like the paper by Banerjee and co-authors in the AJ special issue in 2015, collects a number of papers that shows that yes, microfinance can have positive effects, but overall, it's not really the sort of panacea for world poverty that was thought at the very beginning. Then there are another strand of literature that is not based on RCTs, but it's mostly based on more aggregate data, generally household surveys, and exploit generally sort of natural experiment or quasi-natural experiment in which there are large banking expansion program. And this literature show that microfinance is generally much stronger and much bigger effect in terms of aggregate growth, employment outcomes, and poverty rates. Like there is a paper by Brunel Love on JF on Mexico. There is a paper by Martin Brown and co-authors in Eastern Europe. Franklin Allen and co-authors is also a paper on equity bank in Kenya. So different contexts, but this sort of literature show that there are generally positive effects when there is an expansion in banking in terms of financial inclusion, in terms of aggregate outcomes. So what we do in this paper, we start from this two literature, and we try to answer the question if microfinance can generate positive local spillovers, reducing informational frictions. In this way, microfinance can facilitate the transition of people who were previously unbanked and become banked through microfinance and then move to commercial banks. So the idea is to look at how microfinance can facilitate this transition from being unbanked to getting access to formal banking credit, and these local spillovers can actually explain and try to reconcile the two strands of literature. So how we do that in practice? First of all, we examine this large-scale microcredit expansion program in Rwanda, and we look at this, the effect on access to credit. Second, as I said, we focus on the transition of borrowers from this newly created microfinance institution, which are Umurenge Sacco or USACCOs, how we call in the paper, to commercial banks. And third, we exploit very detailed loan-level data from the Rwandan Credit Registry. And so, given that we have loan-level information, we can try to build and contribute to the two strands of literature that we have said before. First of all, like compared to aggregate studies, the fact that we have loan-level data, we can actually try to go and disentangle the mechanism through which there may be potential spillovers from microfinance to commercial banks. And compared to the RCT literature, again, citing the paper by Banerjee and co-authors, the RCT literature only scratched the surface of identifying spillovers and general equilibrium effects. So the fact that we don't have an experiment, we have administrative data on the whole country and the whole banking system, we can really see what happens, not only in terms of access to credit through the institution which are part of the program, so the microfinance institution, but we can also see what happens to the other part of the banking system, meaning the commercial banks. So in a nutshell, which are our results? The paper is a sort of two different parts. In the first part of the paper, we really look at the microcredit expansion program, and we show that it increased the likelihood of access to credit for people who were previously unbanked. We find that this effect in terms of financial inclusion is stronger in areas which are poorer, less financially developed, and more remote. We also find some evidence that suggests that there is positive effect on local economy, because we find that there is an increase in business creation, and also there is an increase in longer-term mortgage lending. Then, as I said before, we also we are also able to show that the effects in terms of higher financial inclusion as driven by these newly created Umurenge Saccos. On top of that, we also show that there are spillover effects from USACCOs to commercial banks. And we show that commercial banks actually start expanded lending at the extensive margin with a lag. So 1 or 2 years into the program, we see not only microfinance institution lending more, but we also see that commercial banks kind of catch up and start lending also to people who were previously unbanked. In the second part of the paper, we exactly zoom in on these people who switch from Umurenge Sacco to commercial banks. We show that these switching are due to capacity constraints and microfinance institution, and we are documented about 1/10 of the first-time borrowers switch to commercial banks. And focusing on the switchers, we can show that the people who switch are able to get larger, cheaper, and longer-term loans compared to people who don't switch and stayed with microfinance. So this consistent with the idea that the moment you switch, you can get like significant gains in terms of access to better financial conditions. We have some evidence showing that they get smaller loans compared to existing bank borrowers. And finally, there is generally the literature that discuss financial inclusion. So on the one hand, pushes the idea that financial inclusion is very important for economic growth and development, but on the other hand, warns about that, pushing the envelope too far and maybe too fast can lead to financial stability concern. So motivated by that, we look at what happens in terms of like non-performing loans. And what we are able to show is that the people who switch are less risky than the non-switchers, and are similar in terms of risk to existing bank borrowers. So in a nutshell, what we show is that basically commercial banks are able to provide additional credit to people who were previously unbanked and switch without worsening their average portfolio quality. So let me go and jump into the microcredit expansion program. So the program is basically a large program set up by the government to create Umurenge Sacco everywhere in the country. This is one example of one Sacco in one district in Rwanda. So the program is set up by the government, is subsidized at the very beginning, then the subsidies lift off when the SACCOs become break even, when they break even. And the program set up one Umwerenge Sacco in each of the districts in each of the municipalities in Rwanda. So Umwerenge is the word for municipality in the country. So there are 416 municipalities in the country. So there are 416 Umwerenge Sacco in the country set up by the program. So basically there was 0 at the very beginning. There is the program, and we see that over time, each municipality has one Umwerenge Sacco up and working in a few years. The goal is explicitly to provide financial services at low transaction cost, and so target explicitly people who are unbanked. Given that it's a sort of a nationwide program, there are Umwerenge Sacco located both in rural areas and in urban areas, urban areas. In the paper, we discuss a bit of the administrative part of the program and also on how these Umwerenge are administered, but basically people are drawn from local communities and there is some training for loan officer and branch manager, which is provided by the government, again, up to the point in which the SACCO breaks even. The key part for sort of identification is that the program was launched in 2009. Yet the first SACCO were licensed to issue loans in 2011, but most of the Umwerenge SACCO start actually working and lending in 2012 and 2013. So there is a staggered implementation of the program, meaning that each municipality is affected at a different point in time, depending on when the SACCO start granting it loans. So what we do in the paper, we exploit this staggered implementation of the program to compare different municipalities, different point in time. This is a diagram that shows the staggered implementation of the program. On the x-axis there is time, so our data span the overall period from 2009 to 2016, and each of the bar show for each month the number of SACCO that provide the first loan in that given month. And as you can see, the SACCO starts operating at the end of 2011, and then the program starts unrolling in 2012 and also 2013, with some of the SACCO that are late in the game and start lending in 2014, 2015. Clearly, a concern here is that the timing of the implementation, so when the SACCO start operating, clearly may be endogenous and correlated to economic condition. I guess in the back of everybody's mind is that in the most dynamic district, the SACCOs start operating earlier. So if we find any correlation between stronger financial inclusion and the presence of a SACCO, could be simply driven by the fact that those districts are better off to start with. This is a serious concern. We do what we can to address them. So we have anecdotal evidence that coming from our colleagues at the Bank of Rwanda that the program has been rolled out in a quasi-random fashion. We do also some sort of more statistical tests for that. So here we have a table in which we run a duration model in which the dependent variable, the time, the month of the first USACCO loan, and we correlate that with the number of observable at the municipality level. So at the municipality level, we can have presence of banks ex ante, so sort of measure of financial development. So it's a number of branches per capita. We have a measure of economic development, which is nightlight intensity, which is used extensively in the economic growth, especially in developing countries. We have a more direct measure of poverty, which is the poverty headcount ratio coming from the census in 2009, if I remember correctly. And as you can see here from column 1, 2, 3, there is no correlation whatsoever between these observables of economic and financial development, the time in which the first SACCO extend the loan. And also one other concern could be that given that the SACCO has to be authorized by the regulator, which is the National Bank of Rwanda, it may be the case that SACCOs which are closer to Kigali, so to the capital, may be authorized earlier than SACCOs which are farther away at the border with other countries in rural areas. Again, if we measure the distance to the capital, we see no No correlation whatsoever. In the final column, we put everything together again. There is no correlation between the timing of the first loan and the observable that we can measure. We do same regression with the district fixed effect, and again, there are no results. So this is sort of to strengthen our identifying assumption. So let me now get to the data. So the Rwanda Credit Registry is the key ingredient of our data. The registry has monthly information on loan exposure to individual by all financial institutions, to commercial banks, microfinance over 9 years. It's a quite impressive database because it covers individual and firms, even though in this paper we only look at individuals. There is no threshold for loan size, meaning that all loans are there, even very small loans for very small activities, and it's very nice because generally for credit registers that are, I'm thinking about like the Italian or the German one or even the Spanish one, there are thresholds for loan size. And for each bank borrower pair, we observe a number of characteristics. We see the loan amount, the interest, we can compute the interest rate, we know the maturity of the loan, we know if the loans goes into arrears. We have some information on loan purpose, which is not very detailed, but at least we know if it's consumer loan, business loan, or mortgages. On the downside, compared to other data that people generally use in advanced economies, we can do one side of the match. So we can match the loan level information with the bank, the originating bank. So we have all the information on bank balance sheet, but we don't have information on the borrower. So we can double match the credit registry with the borrower. But from the borrower characteristics, we only know its location at the municipality level, which is very important for us. We know the age, gender, marital status, and again, we have some information on the employer, which again, it's not very easy to code because it's part in French, part in English, part in local language. The credit registry, as I said, covers the whole financial system. So we have 16 banks, as I said, 416 Umarange SACCOs and other 67 MFIs. And it's highly representative of total bank credit. Like if we plot on the blue line, the total lending from the credit registry and total lending from bank balance sheet, so the aggregate we get from the central bank, you can see that basically we cover all lending in the country, and more important, the trend over time is exactly the same. So we have the same sort of coverage at the very beginning of the period and the very end, and here in 2011 is when the program starts. So we are very good in terms of coverage. Once we clean the database, because we have clearly issue with outliers or missing information, we have about 180,000 individuals borrowing from all financial institutions between 2008 and 2016 in 336 municipalities. And the moment we create a panel database, which is fully rectangularized, we have about 20 million observations. The reason why we drop from 4 and 16 municipalities to 336, because there are some municipalities which is the same name as the district or as the region, and so it's impossible for us to pin down the exact location of the borrower. But again, even in this case, we do some control, and the municipalities that we drop are kind of random. They are distributed like homogeneously through the country. So first part of the paper, access to credit. The equation that we estimate is relatively straightforward. So it's a diff in diff on a panel database in which on the left-hand side, you have the probability, the individual I in municipality M in the month T, time T, obtain a loan is a function of a set of variables. The key explanatory variable is this post U-Sacco Dammi, which varies, as I said, over time and across municipalities, because we have municipalities that start at different point in time extending their first loan. So this time is equal to 1. After the Sacco start granting the loan in a given municipality in a given month, at 0 before. Then we have a set of controls at the individual level. As I said, we know gender, marital status, age, and sector of employment. And then we saturate the model with a set of dummies. So we have municipality fixed effect, month fixed effect, and in the most restrictive specification, we have municipality specific time trend. So everything is identified as a deviation from trend. And as I said, the database is a fully balanced borrower municipality month panel with about 19 million observations. And this is the results in a visual picture. So it's a diff in diff, and as you can see, there is no evidence. There is the pre experiment period show that there are no parallel trend. And after the program, after the implementation of the program, you see that the probability of getting a loan goes up and actually increases over time. So the effect is positive and significant already in the first year. So the probability goes up by about 4%. It becomes even more in the second year and even more in the third year. So it's an economically large effect. It's a persistent effect. It increases and stays there over time. So this is sort of the first result. On average, we see this stronger effect in terms of financial inclusion and access to credit. Visually, we can see the same thing. This is like the share of the number of individuals with a loan per 1,000 inhabitants in all municipalities in Rwanda. Before the program, after the program, like visually, you see that the all municipality becomes darker. And so this is, again, consistent with the fact that there is a stronger access, larger access to credit. And these same results in a table. So we have all the controls, all the fixed effect, and this is the point estimate. What is nice, and again, let me show you with the chart here, is that compared to, as I said, to the aggregate peak studies that use survey or aggregate data, here we can really show who is providing credit. So we can run the same model, but with the dependent variable being a loan extended by Umerenge Sacco, a loan extended by a bank, the red dots, and the loan extended by other microfinance institution in the country. And as you can see, again, there is nothing before the program, so there is no parallel trend. After the program, you can see, as before, that the average effect is clearly driven by microfinance, by the Umerenge Saccos. But what is more interesting is that starting the second year of the program, there is some sort of catching up by commercial banks. So even commercial banks in the second year and even more in the third year start lending to the people. So here is the first sort of novel element of the paper, this spillover effect to commercial banks, which again is shown here by, okay, I don't have the table here, or maybe it's here. Okay, I have it here. If we split the results by even the overall results and those by commercial banks and the microfinance institution, we can see that there is this effect also driven by commercial banks the second and third year into the program. We do a lot of robustness and extensions around this first set of results. We have falsification tests in which we randomly assign the treatment across municipalities and over time, and we find that the results are 0. We use, in the one I've shown, there are results based on the monthly frequency of the data. We aggregate up at the yearly reported frequency because to reduce the number of zeros. And again, there are no differences. We also use the FinScope survey, which is very nice because basically we can do the same exercise, but based on survey data, so a completely different data set. And again, we have very similar evidence because FinScope asks a question on financial inclusion and also separate out between microfinance, SACCOs, and commercial banks. And also we can see, because we have a FinScope wave in 2011 or 12, which is, we considered sort of the pre-period, and then we have a 2016 survey, which is after, and we can see again similar differences. Then we have evidence on, as I said, on spillover to local economies. Let me show the table here. We can look at the number of business loans, for instance, or number of firms over population, and we can see that in the first and second year into the program, there is an increase in the number of firms per capita, in the number of business loans, and also in the number of mortgage lending. So there is some evidence that it's not simply just loans for consumption, but something that can have sort of real effects. Then, as I said at the beginning, we have a lot of results in terms of spatial heterogeneity, which are consistent with the literature that show that this financial inclusion effect are mostly driven by areas which are remote, so farther from like Kigali, and which are less financially developed and less economically developed to start with. And then we have some evidence of borrower heterogeneity, even though this is something which we don't push in the paper because since we cannot control actually for credit demand at the individual level, it's very, very descriptive. So maybe we can come back on that on the Q&A if you're interested. Let me now try to go to the second part of the paper. So to look at the sort of switching from SACCO to commercial banks, we have to document first that there are capacity constraints at SACCOs. Again, there are anecdotal evidence that there is sort of regulation that explain why SACCOs are at capacity constraints. For instance, like they have maturity mismatch, they have regulation on portfolio concentration for which they cannot have like large exposures. So SACCOs are not able to provide sufficiently large loans, sufficiently long-term loans if some of their borrowers want this type of products. So this creates incentive for people to switch to commercial banks. And also in the data, we see that there are the moment for people that stays at SACCO clearly benefits from repeated lending. So it's consistent with dynamic incentive to repay and the benefits of relationship lending. There is an extensive literature on banking. And we show that the people who keep on borrowing from SACCO, loan after loans get better credit terms, like meaning larger loans and cheaper loans and longer term loans. That said, it seemed that at some point you hit a wall and SACCOs are not able to give you much more. And in fact, if we compare the last loan at SACCO with the first loan that people get at banks, we find that banks provide much larger loans. It's a 0.8 million Rwandan franc larger loans, 2.6% reduction in interest rate spread, and sort of 8 or more month more in terms of loan maturity. So it's the first evidence that banks are able to provide better loan conditions. So this creates incentive for people to switch to commercial banks. Then we also see that commercial banks react to the program. So the program clearly set up SACCOs everywhere in the country, in each of the municipalities, but commercial banks also increase their bank presence. So here is a growth bank branches set to 100 at the year of the month of the program. And you can see that the number of bank branches by commercial banks goes up, but goes up even more in areas in which banks have a low presence to start with. So there is evidence suggesting that banks are able to extend their supply and so provide more to increase the number of bank branches. They do even more in more remote areas. So this is consistent with the idea that commercial banks realize that there are good lending opportunities because they see that SACCOs are able to lend and people actually repay. So banks see that in the credit registry. And so they react, they expand their branch network because they want to expand lending, especially in areas in which they were not present before. So even if we simply look in a very descriptive way on how banks react and expand their network, we see some evidence suggesting that banks are really expanding their network in more remote areas. And because of this capacity constraint, as I said at the beginning, we see that about 10% of first-time Umurenga SACCO borrowers that need additional loans switch to commercial banks. And so in the second part of the paper, we look exactly at these switchers. So switching loans are defined as new loans to individuals who had their first borrowing relation with a SACCO and establish a new borrowing relation with the commercial banks. So we follow a strategy which is very similar to the JF paper by Ioannidou and Ongina in 2010. They compare switching loans with new loans granted by SACCOs to people who don't switch. And also we compare the switching loans to new loans granted by banks to their existing bank borrowers. So basically we want to compare the people who switch to similar borrowers to decide not to switch and to similar borrowers who already are customer of commercial banks. And we want to look at how lending terms changes. We do that with a matching estimator, sort of bias-corrected nearest neighbor matching estimator. So what we do in practice, we do exact matching on a number of loan individual characteristics. So we match loans that are granted in the same month to borrowers of the same age group, same gender, same marital status, same employment status. And then within this set of borrowers which are matched exactly, we select the nearest neighbor on a set of continuous loan level and municipality level variables. Even on that, we do a number of robustness, and the results are very, very similar. So first of all, we document that the program actually increased the probability of switching. So here we run a regression which is very similar to what we have done before for the probability of getting a loan. Here, independent variable is the probability of switching from microfinance to commercial banks. It's not an individual level, but it's done at the municipality level. So the panel is municipality time level. And we have, again, borrower control, time fixed effect, municipality fixed effect, and time trend. And what we show here is that, again, the probability of switching, however you define the number of switching or the number of switches divided by the number of borrowers, the of population of MFI borrowers, increases over time, starting the second year of the program. Again, consistent with what you've seen before, there is the program, there is stronger financial inclusion provided by UMaRengue Sacco. The second year of the program, commercial bank starts lending, and here consistently we show the second and third year of the program there is a higher probability of switching from SACCOs to commercial banks. Then we look at the switching loans to look at loan terms. Here we compare switchers and non-switchers. So in the first three columns here, the control group is the new loans provided by SACCOs to people who don't switch and stay with the SACCOs. So the results here tells us that people who switch get larger loans, cheaper loans, and longer term loans. So the effect is economically large. So here is 0.4 million Rwandan francs, which is about $400 to $500, which is a large effect because the average loan size at SACCOs is about less than $1 million. So this is a 40% increase in terms of loan size. In terms of interest rate, again, it's a significant discount because the average or the median interest rate on SACCO loans is about 24%. So we are in the order of 10% discount in terms of interest rate spread. And in loan maturity, here we're talking about like 5 months more in terms of maturity. Again, the median loan at SACCOs is 1 year. So again, you can move from a 12-month to a almost 18-month loan, which is a large effect. If instead we compare borrowers who switch from SACCO to commercial banks to similar people who are already commercial banks, we basically see no effect. We see some effect of that they get a sort of smaller loans, which is consistent with the fact that these people coming from SACCO probably have a sort of lower loan demand. And we have some evidence so that they get like a longer term loans. That said, if we restrict this control group to people who switch, so if you compare switcher from SACCOs to commercial banks with bank-to-bank switchers, and this is here, we find there is no effect whatsoever. So basically, if we constrain the relationship length to be 0 for everybody, there is no effect here, but we still have the same effect here. So even if we compare people who switch from SACCOs to commercial banks, and we compare from SACCO to SACCO switchers, so again, relationship length set to 0 by construction, we have again the same effect. Then the last result that we have, and I guess I am most on time, it's about like non-performing loans. So as I said, there is a concern that this idea that we said that the program is has been very successful to push financial inclusion. So SACCOs has been providing a lot of credit. And on top of that, commercial banks reacted extending credit to people who switched to SACCO to commercial banks. A concern could be that the expansion of credit could reduce loan quality, and so NPLs can go up. So we look at the risk profile. Clearly, we don't have, unfortunately, we don't have a measure of ex-ante riskiness of the borrowers. The only thing we can observe is if a loan goes into arrears. So we look at ex-post NPLs, and we look at loans that goes into arrears within a year from origination, within 2 years from origination, or any time until maturity. And again, we compare people who switch from SACCOs to commercial banks, from bank to bank switchers. And the people who switch from SACCOs to commercial banks are actually better, so less risky than people who remains at SACCOs. So you can see the probability of running into arrears is significantly lower from the switcher than the non-switchers. At the same time, these people who switch are not riskier than existing bank borrowers. So these pieces of evidence combined suggest that commercial banks are able to expand their portfolio, poaching and getting the sort of cream skimming the best among the pool of borrowers SACCOs. At the same time, they don't worsen the average portfolio quality. So the story that we have in mind is a story in which the program is actually able to push and increase access to finance. Through the credit registry, people are able to build credit history. And the moment they build credit history, are able to, some of them that need larger and longer term loans are able to switch to commercial banks. Commercial banks, again, can look at the credit registry, they look at credit history, they see that there are good lending opportunities, that there are actually people who are not bank, but actually are good borrowers, because are borrowers that can borrow and repay on time. So they start lending. And in fact, we have seen that banks actually physically expand their branch network, especially in areas in which they were not present before. They borrow, they lend to these people, and these people actually repay because they're not, or at least they repay in the same fashion as existing bank borrowers. So banks are able to push and expand their credit portfolio without worsening the quality of their portfolio. So to conclude, what we document in the paper is that this microcredit expansion program set up in Rwanda increased the likelihood of access to credit for people who were previously unbanked. There are strong spillover effects to commercial banks. So commercial banks expand their branch network, especially in areas in which they were not present before, and also expand lending and extensive margins starting the second year of the program. This is exactly consistent with the fact that loans extended by SACCOs are maturity of 1 year. So you get a loan, you repay a loan in 1 year, you show you have good credit history, and banks start lending to you if you switch to commercial banks. We show that a significant fraction of first-time, less risky borrowers switch to commercial banks, and commercial banks cream scheme among the microfinance borrowers. So we have sort of two main conclusions. The first one is that microfinance, especially if it goes together with a well-functioning credit registry, can mitigate informational friction and can serve as a pathway for first-time borrowers to switch to commercial banks. It's sort of a stepping stone for which people who are unbanked get credit, learn how to borrow and repay, and then if they have good and large borrowing need, they can borrow to commercial bank. This sort of mechanism of microfinance as a stepping stone into commercial banks can sort of reconcile these two strands of literature, in which if we only look at microfinance through what it is, we don't really see a lot of aggregate effect. If you look at the aggregate data, we see instead stronger aggregate effect, and the spillover effect to commercial banks may explain why there are these two differences in the two literature. Clearly, there may be an unintended consequence of the program, which is already documented by the fact that if it's true that commercial banks cream scheme among the pool of microfinance borrowers, you SACCOs may be left with a pool of risky borrowers. So the bad guys can stay with the SACCOs. And this may undermine the financial viability of the business model of the SACCOs. In the paper, we don't go that far on the dimension for a number of reasons. First of all, like over our time period, Rwanda was growing at very high growth rates, so it's very difficult to see a lot of non-performing loans. But that said, we have some aggregate statistic at the USACO level, sort of the all institutions together, that already show that by the end of sort of 2015, 16, even more 17, like NPLs at the system level from Umarange SACCOs are going up, while NPLs by commercial banks are overall flat. So there is some suggestive evidence that sort of cream skimming may go at a disadvantage from SACCOs. So sort of from a welfare perspective, it's not exactly clear which are the implications, but again, we our paper is not about like the welfare implication of the program, which we leave for further research. And with that time, no, thanks.
Thank you. Thanks, Andrea, for the presentation. We are going to open up for questions now, folks. There is a question here, Andrea, coming from Lucas. If I live in municipality X, is it possible to borrow from municipality Y, for instance? Could I go to my neighbor municipality to borrow money?
Yes, so this is a good point. It's a good question that came up a number of times. For us, it's very difficult to have a sort of a clear cut, like a sort of econometric answer to that, in a sense that we cannot exclude that, because what we have the location of the borrower, and we see that the guy is borrowing and from the SACCO. So if I see that the guy is borrowing from a SACCO in a given municipality, I assume that the guy is living in that municipality. So in principle, it could very well be the case that people move from one municipality to the other. In practice, again, we have a lot of anecdotal evidence. I've spoken to some of loan officers at SACCOs. Our colleague at the central banks also told us it's very unlikely, meaning that there is one SACCO per municipality. As you know, Rwanda is a very small country, 416 municipality, and SACCOs mean that there is basically one SACCO everywhere in the country. Transportation, and so it's very costly to go from a municipality to go to a SACCO in a different municipality. So we think it's very unlikely, and on top of that, the SACCO is really built as sort of a SACCO for the local community, especially at the very beginning when they have to raise savings before start extending loans. It's really based on it's really an institution of the community. People are supposed to use the SACCO in their community. There is a lot of issue like trust. There is a lot of sort of moral suasion and soft enforcement for people to be active in the community and be customer of the local SACCO. So bottom line, I don't think it's something that really happens.
Okay, thanks. Logan has a question. Logan, can you unmute yourself and ask the question directly to Andrea, please? Thank you.
Yeah, sure. Thanks, Manuel. Andrea, thank you very much. That was an extremely interesting presentation. Just two questions from my side. This may be, due to my ignorance as well. I haven't really followed the Rwandan situation very well. But in terms of, let's say, some characteristics of these microcredit loans that were given by SACCO, could you tell us a little bit about the interest rates that were charged on these loans, maybe vis-a-vis some other benchmarks like commercial banks, etc.? Then the other thing is that it would seem as though, at least from some of the work that I've read, that gender, matters, and in particular, when you give these loans to women. And then the sectors in which, these loans have been used. Is there a bias towards agricultural activity or some other small scale, initiative? So that's the first question. Then the second question comes on, basically from your conclusion, right? Yeah. What are the policy implications? Yeah. If I'm hearing you correctly, and I could be wrong here, is it right to say that you are now advocating, at least your results seem to suggest that maybe we should go for a two-tiered system in which you have, entities like, SACCOs taking over the more riskier, loans, and then acting as a transition to the commercial banks or commercial sector. And then the commercial sector can then give larger loans for less riskier clients. If I'm hearing you right, that's what I seem to, hear you say. But isn't there some scope for, given the fact that you've got larger resources in the commercial sector, to try and also entice the commercial sector to also make inroads into lending into more riskier, ventures, or is that something that's not viable? Yeah, let me leave it there, Manuel. Thank you, Andrea.
Oh, thanks. Let me go in order. They are all good points. So on the interest rates, I think I should have said at the beginning, I forgot. So the paper is about SACCOs and microfinance, but the loan that they provide is a traditional bank loan. So it's not a sort of microfinance, joint liability loans or community loans. So it's an individual loan, individual liability. It's very standard. The only difference is clearly in the lending technology, which is reflected in interest rate. So the lending technology meaning that it's really based on, compared to commercial banks, there is a much stronger knowledge of the borrower. So informational frictions are overcome because of, being in the same community. People, the banks really know, the SACCO really know their customer base, and they can assess credit worthiness much better. In terms of interest rate, as I said, like the median interest rate is about 24% or so. Commercial banks are cheaper, are about 18%. What is striking is especially among SACCOs, that it's very little variation in terms of interest rates. Is almost standard, which is about 24% or so. It's also generally uncollateralized. There is some informal collateral, which is movable collateral. So that's how it is, and that's why for people it's convenient to switch, because you get significantly cheaper loans if you can switch to commercial banks. That's why it's important to have SACCOs to help people move from microfinance to commercial banks, because it's very unlikely that we see in the registry people who are unbanked and all of a sudden get their first loan in commercial banks. What we see in the data is that people are unbanked, get credit through SACCOs, and then switch to commercial banks. So that's why we think it's important having this sort of system of SACCOs to allow people to transition. And that goes to your second question, and then I come back to gender. Your second question about the policy implication, how we see a way to organize the financial sector. So I think our paper tells that, there is a lot of hype now about fintech and all that, and mobile loans, mobile lending. I think it's very important, and I don't want to dismiss that. And actually, we have other projects on that, and I think it's very important. But our paper tells that, an old-style brick-and-mortar program in which you set up physical bank branch location all over the country, it's very successful. It's you reduce informational frictions. You can provide a lot of other things. We have something in the paper, the moment you have the SACCOs, you also provide financial literacy program, a lot of other things which are very important. So it's a system that really works to provide financial inclusion. Rwanda is a great study for that. Again, if you look at FinScope aggregate statistics, Rwanda was very successful. I've seen recently the 2020 numbers came out, and Rwanda is really good on that. So financial inclusion expanded very well. So the point is that on the policy implication of where the equilibrium should be right now, I think clearly, it depends on the objective function of the policymaker. The policymaker clearly put money on that, and because it subsidized the program, and one could read our results as it's an implicit subsidy to the commercial banks, because in the end, commercial banks are getting the good out of that. So the SACCOs do the work of screening. The moment they identify the good borrower, some of the good borrowers transition to commercial banks. Commercial banks basically take advantage of this production of information, which is done by SACCOs with the money of the government. But again, it depends on which is the objective function. It could be actually money well spent. In equilibrium, as I said, there is a problem of increasing NPLs on SACCOs. And from what I've known, the last time we discussed with people at the central banks, there was a discussion about reforming the Umurenge SACCO, or actually the SACCO system, trying to centralizing at least HR and IT function to save money, and that could be a administrative organization in which you can have still a decentralized system to reduce informational friction, but then you try to centralize IT and HR and a lot of other functions. Finally, let me go to gender. It's true, it's very important, and in fact, at the very beginning, we wanted to do something on gender. The point, as I said, is that we are not able to separate demand and supply, because generally, when you have this credit registry data on advanced, on richer countries, you can have like individual fixed effect, because you have people borrowing at the same time from different banks. Here, we can do that. So we don't know if we observe more women borrowing more. It could simply be because they have higher demand. So we do some regression here, and as you can see, like we interact our post-SACCO for some individual characteristics, and if anything, we see that the female dummy interacted by the post-dummy is negative, showing that the expansion of credit is stronger for men than for women. But again, it could simply reflect that men has stronger credit than women, which makes a lot of sense in that context. So that said, we unfortunately we can't say much more on that on the gender side.
Okay, thanks. Thanks, Andrea. There is another question here. I think you touched upon that, but anyway, is it possible for SACCOs to provide syndicated loans to individuals needing larger loans than an individual SACCO cannot provide?
No, as far as I know, no. I'm not sure, and especially because, from what I understand, like SACCOs really lend to their people who are next to them, and but that even, you know, for instance, like in the city of Kigali, I think Kigali has 7 municipalities or so, meaning there are 7 SACCOs already in Kigali. And maybe in Kigali, you know, you take a moto and you go somewhere else, it could be the case. But, you know, then I travel the country, and the moment you are like at the border with Burundi, there's no way, you know, even going to your SACCOs, unless it's next to you, it may take an hour or so, no? Or even, so I think it's very unlikely you want to like go to different SACCOs and try to syndicate a loan. It's and then again, they're very small, you know, they're relatively small loan, quite standard loan in terms of loan size, long term. So I don't think it's the case.
Okay, thanks, Andrea. There is another question from Nolwazi. Given that we see that borrowers are moving from SACCOs to commercial banks, what implications does this have for new fintechs that want to offer credit service, as we are seeing in Kenya with M-Shwari? Is there no business case in Rwanda? Does the regulation in Rwanda allow for that?
Oh, no, that's exactly what we would like to do, what we're trying to do in separate projects, and actually in other countries, but also in Rwanda. In Rwanda, there are mobile loans. So there is Mocash, if I'm correct. And we are in the process of getting those data to study exactly that. So I think that would be really interesting to see the interaction between sort of a more traditional way of extending credit, which is the SACCOs, and the mobile. The very fact that Mocash is there, and I've only seen aggregate data, aggregate statistic, but it's huge. So the volume of, you know, the volume are not that huge because loans is very small, but these mobile loans, the number of loans is very high. And I've seen numbers on Tanzania as well, and in Kenya as well. The very fact that this mobile lending is very big, at least in terms of like number of customers who uses them and the number of loans, tells you that the two things can coexist. What I've seen, which is a little bit worrying, that's exactly why we are interested in that, is it seems that it's like, for instance, here we look at, you know, what we see, that our last results here show that, you know, arrears, so financial stability concern are not actually there. The number I've seen, there are a couple of studies provided by people affiliated with the CGAP and the World Bank, I guess exactly for Tanzania and Kenya, show that NPS or default rates for people who take out mobile loans are incredibly high. So this mobile loan seems to be a very different lending technology. So here it's a traditional lending technology. I know my customer. I know it's a good guy. I lend you something. If you repay, I lend you a little bit more, the moment. And then if you really need a lot, you go to commercial banks. From what I've read and from what I've seen, it seems that the mobile loans it's a very standardized, it's a very cheap product for a bank. And so it seems to me that it's a technology in which you provide lending to everybody who asks for a loan, then a lot of these people default. If you default from a bank perspective, it's not really a big issue because it's a tiny loan, but it's used as a screening technology. So I lend to everybody. I can cheaply understand who is a good guy and the bad guy. The bad guy is out of the market. The good guy is someone that I can use. And the moment it becomes my customer, I can cross-sell other products. So I think it's a very different thing. It's a very different market. And in fact, it's provided like Mocash is provided. It used to be like CBA, so it was one bank. This is SACCOs, it's cooperative things, a very different thing.
Okay, there is one more question, Andrea from Robinson. Andrea said SACCO issue loans to people within their vicinity. If SACCO issue loans to those close to them, could I be wrong to say social capital also plays a key role in these loans?
No, I think it's right. And again, it's something that we are trying to sort out, revising the paper. I think what we would like to do is try to say something more on the lending technology, rather now in the paper we speculate a little bit on anecdotal evidence or what we know talking from people, but we would like to say something more based on the data. But yes, in the back of our mind, what we have in mind is that it's the success in terms of like lending and screening is through like lower informational frictions, through like the social capital and the fact that people know each other. We know we have something concrete in terms of transportation costs, because at least there are survey data that tells us that travel time went down after the SACCO start operating in the municipalities. We would love to say something in terms of like even social capital or trust or this kind of issues.
I have a question. I saw that you showed us some data on, for instance, on mortgages, on increased number of mortgages. But do you actually know what these people are doing with the money? Do you have hard evidence, or doesn't matter, or is it another paper?
No. So we don't know exactly what they're doing. We know we try to infer from loan purpose, and the question was, let's say, at the very beginning, we wanted to write a paper, so we went immediately like financial inclusion and real effects, economic growth, economic development, poverty. And then, the paper that I cited at the beginning, like the Brunelov, Rohini Pandey's paper on India, they do exactly that. So we saw that the switching, and we still think that the switching is the novel part of the paper. That said, people keep on coming back to us and saying, but what are the real effects? So I guess we go back and try to show something on the real effects. So at the individual level, we cannot say anything because we don't know exactly what people are doing, and we cannot trace the individual. So there is an helicopter coming. But what we can show, what we should be able to do is do something on, I think we should be able to have like household surveys, like when we compute poverty rates before and after at the municipality level. That one is something that we should be able to do. And maybe we can have also some other indicator at the municipality level before and after. Unfortunately, we wanted to do the easiest one, which is night lights, but the satellite changed it exactly around the program. And these people working at NASA with satellite data told us that there is no way to reconcile the 2016 light with the 2008 lights. Even if we do delta on delta, we can do that. So we are left with this poverty headcount ratio if we can compute them. So we'll try to do that but we are confident that there are real effects, because at least in the descriptive way, you see that.
Okay, thanks.
Thank you very much.
Any other question, folks? 1, 2, 3. No? Okay. Thanks. Let me thank Andrea again. Thanks for taking the time and coming and talking to us. Okay. Okay. There's some Logan is just saying thanks.
No, thank you very much.
So it's also thanks to all participants, and again thanks to Economic Research Southern Africa for supporting this webinar series. I will stop recording now.